Welcome back, investors. Today we are looking at Nike. I was hoping to have a chance to read through the entire 10K filing with the SEC. However, they have not released that yet. I noticed that they were supposed to release their financials on the 29th of June, and I assumed that the 10K would follow with that. It looks like last year they didn't release the 10K until July 21st, so probably a good chance they'll have that filing published around that time. Of course, the quarterly earnings came out, and that pushed the price down a little bit. I know a lot of people are talking about Nike, and so I figured, hey, I've had this all put together, and this is one of those fun stocks where I'd already started it, and then they released new information. And on Seeking Alpha, you only get 5 years worth of information, so I've only been able to go back 2018 to 2022. Well, now I have 2023 data for Nike, so I actually have 6 years here. So to look at some basic ratios and everything, our ISS governance scores, they look all right. Audit coming in at an 8, ISS board at a 10, which it's 1 to 10, 10 being the worst, 1 being the best. So not good, but it's just a bigger company. A lot of times, you know, institutional shareholders tend to push past the smaller retail shareholders. So they do tend to have higher scores there. Compensation actually at a 2, so that means their board and executives aren't too overpaid, so that's good. Profit margins, not actually bad. Again, recent squeeze with the last year or so, but still looking good. And I think that's something really, if you want to skip ahead to kind of my overall opinion and my diagnosis of Nike, it's that, yes, they missed some earnings reports, expectations, but honestly, the company is still doing well. They've got some minor problems, and we'll dig into that. But again, still a quality company, still has I believe, a bright future. Looking at their price earnings ratios, a bit high for me, but again, kind of coming down there. And of course, this isn't for 2020, even though it's under that column, just to clarify. And so this last year, it's run about 32 times earnings. Looking forward, it's supposed to be about 28. And again, that just depends on whether earnings can grow and price can remain stable. But people not too overpaying, but this tends to be one of those things with blue chip stocks. People are really willing to pay whatever because they expect the company to be around for a long time. Looking at that PEG ratio, 1.89, I think that's a nice healthy place there. I prefer to be under 1 or right at 1, but underneath 2 is not a bad place. Price to book running about right at 12. Again, one of those things where I prefer it to be right around 2.5 or below, ideally less than 1, but when you have large intangible assets like their trademark and copyrights and some of their patents and everything, price to book is going to be a little inflated, and that's just part of life there. Price to sales at 3.53, really not too bad. Again, one of those things you want to see a lower number, but 3.5 is not bad. Past 5-year growth, next 5-year growth, pretty average looking, not double digits like you might want, but I know a lot of dividend investors like Nike because it's stable. They have a solid dividend plan and they can cover it. So, you know, a lot of investors are willing to accept lower growth there. Operating cash flow, levered free cash flow, good numbers, nice and positive, hitting in the billions. So can't complain with either of those. They can meet their debt obligations and pay their bills. Looking at their dividend, it's increasing over the year. So that's a positive sign. The company sees itself in a healthy position and, you know, again, believes in itself to be able to meet those obligations. Insider ownership, nice and high, over 1%. So again, that means those inside the company, you know, see future growth, are willing to buy the shares. And that's always a strong sign to me as an investor. Some others may not feel that way. Definitely drop that in the comment if you don't. As far as current price, it's actually not at 112. It's actually closer to 110 right now. That was a big headline on Friday. So it's 4th of July weekend, so markets are closed. Kind of bummed out about that. But there on Friday before this, I believe that was June 30th, the price dropped to 110, and it was a pretty big drop for Nike. Again, that comes out with their earnings report, and we'll get into that a little bit. Price history, it's grown over time, still at 110. From 2018, it's grown over 7%. So not a bad place to be at with a compounded annual growth rate, because that takes into the rate of return into consideration. So looking at working capital, ability to generate money, this is where Nike has a little problem. The main thing I want to focus on here, again, this video is mostly going to be quantitative. We're looking at numbers. I try to dig up a little qualitative information, but it's kind of limited because I don't have the 10K with the notes of the financials and everything. So current ratio has increased 1.39. That's not a bad place to be at. However, debt to equity there under capitalization has increased by 14%. So it looks like they have been pulling in a little more debt to sustain a strong current ratio, sustain having cash on hand. So a little problematic, but otherwise not terrible. Something to look into there with their use of debt. As far as quick ratio goes, well over 1, hits over 2 in 2021, probably with the rebound from COVID. So still a growth, almost 2%. Again, I'm concerned with increasing debt to basically keep those cash levels high, keep those current assets high. And, the quick ratio does take out inventory, which is our main problem here with Nike. And that's here in the next line, inventory turnover and days turnover. Your inventory turnover goal is 4+. As you can see there, it's decreased by 2.5% over the last 6 years. That's problematic. And where you can really see it is this days inventory. What these numbers tell you is how quickly the company can generate the inventory and then get it sold. So you want to see less than 95 on the day's inventory. That's how long, based on this ratio, the inventory is sitting there, not being sold. So you want to see less than 95. The last time they had that was in 2019, so pre-COVID. Of course, you have backlogs in supply chains and everything. Well, moving into 2022, 2023, you would expect it to really decrease sharply, but it's continued to stay pretty high, even increasing. So that's kind of the big headline story with Nike. Just a big glut of inventory, not able to push it. And I'll kind of dig into that with somewhat qualitative information there below. And if you want to read ahead, it's right there. As far as cash generating power ratio, it has increased. This has to do with the cash flow statement and its ability to generate cash through its products and not from taking on debt or taking on financing, which is the same thing, I guess, or with, from sale of securities or other things that aren't related to its operating income. So a nice place there. Ideally, you want to see that going up. You have a big dip in 2020, makes sense. But slight increase over time. It looks nice and healthy to me. Obviously, you want to see sustained growth. You don't want to see it fluctuating too much, but we do live in strange times. So the fact that it's at least gone up over the last 6 years, I see as positive. Jumping back into capitalization, I mentioned debt to equity increasing by 14%. Debt to assets also increasing by 11%. These are not numbers you want to see increasing this much. Again, you might see a little bit, 2 or 3%, but to be in double digits is a little problematic. So something we really want to see Nike doing is paying down this debt because it is taking a larger and larger portion of the balance sheet away from the actual assets sitting on the books, the actual equity that shareholders have in the company, as well as the fact that this doesn't even include other long-term liabilities. It's just debt. As far as tangible book value per share, it's trading at a much higher price to book value, but it has grown over time. You want to see this number higher because that means that the amount of real tangible assets on the books are increasing. and we see a almost 7% increase there. So that's nice and healthy. I feel good about that as an investor. And to clarify, I don't own any shares of Nike. So definitely take my opinions with a grain of salt, I guess. As far as profitability, revenue is increasing by about 6%. Gross profit margin has increased by almost 6% over 6 years. You see some dips once in a while, but really sustained growth. It's a healthy company. You know, they are generating cash from their operations, not from external factors. What a lot of people have pointed out is the operating margin has gotten a little squeezed, dipped down about 1% over the last 6 years. But again, I'm not terribly concerned if I'm looking at this company. They've had a rough 2022, 2023. It's taking more money to get their products out the door. It's slowing down for them. But of all the companies that can handle this, Nike is definitely up there. As far as earnings per share, this is diluted earnings per share. It's increased by about 19% over the last 6 years. Again, you see a little bit of a dip, 2021 to 2022, nice growth, and then dips down in 2023. But again, 6 years and nice solid growth, even with a little dip here and there. I would feel very comfortable owning this company personally. Going into noteworthy, again, I prefer to have much more detailed. You know, a lot of companies that I evaluate, I've got all of these squares filled up. Just interesting stuff, audit-related issues, and lots of different factors, risk factors especially, that affect the companies. But just a few things here, just looking really at the news is the main thing, looking through their press releases on their website. So again, you want to see things from the company itself, how they're portraying themselves. But again, without the auditors' comments and everything, you're not always getting the full story. But big thing in the news, you know, they're going back to stocking their products at Macy's and Designer Shoe Warehouse. A lot of people have pointed out, you know, Nike had undergone a major direct-to-consumer strategy, not putting it out in stores through, you know, distributors of their products, but trying to sell them directly to end consumers. And of course, by putting it back in stores and stuff, it seems like they're shifting away from that big push. So looks like their direct-to-consumer strategy maybe didn't work out quite the way they hoped. Their Converse brand has struggled recently. They got a new CEO back in May. That's usually a sign that they really want to turn things around. So, you know, hopefully that works out for them in one of their major segments. China lockdown really affected the company. It's a big market for them, as well as being able to get products out to the rest of the world. And then also foreign exchange rates were really unfavorable for Nike in the way that, you know, the places they do their business and how they do their business. And that's really challenged the bottom line. As well, the footwear industry, the competitors, it's becoming a much wider range of competitors. On Holding AG, it's a Swiss company. They're relatively new. They're much smaller, but they've already, you know, they've got like 90% of their sales are in North America. You got Roger Federer, took them up as a, you know, brand rep. And so, you know, there's still pressure on Nike from these kind of outside forces. However, Nike remains the gold standard in the industry. Very strong company, and I think it can weather even newer competitors entering against them. You know, you have effects of, you know, especially moving away from direct to consumer. One of their major partners, Foot Locker, has introduced this Lace Up initiative. It's a turnaround initiative. And so that's going to cause some competition for shelf space with Nike. They're trying to introduce a lot of their own products, Foot Locker is, and that may cause some issues moving back into the distributor model that they have. Again, I still think they're a good long-term story. I think there's lots of growth to be had. We may see some consumer pullback with the student loan forgiveness getting struck down by the Supreme Court last week, but looks like the current executive administration is doing some things to stretch out that burden on consumers. So I think Nike should benefit from that. They continue to show sales strength. They have high consumer engagement. They just have tightened margins, which I think is what's caused problems. They have kind of pluses and minuses, right? There's stronger initiatives into women's sports. I think they're really tapping into that market. They're having women partner with them to create better products, more designed with them in mind. So that's going to increase sales to, over 50% of the population. But also on the negative side, they continue occasionally to have, they really benefit from deals with major personalities. So back in December of 2022, they announced a partnership with Ja Morant. Of course, he's been the subject of a lot of bad press with displaying guns and social media posts and such. And so one of those things, they continue to maintain that deal. But that depends on, basically staking your name to someone else that they don't have control of necessarily and the way they display themselves. And so not to say Ja Morant's a bad person or anything like that, but, these kinds of deals can make or break a big company like that and their margins, as we've seen recently with other companies. And then really the main thing I want to talk about, the video's almost over, but the big thing here, I think the story with Nike is, you have these things called an earning miss, right? Like analysts, they say, okay, this is what we think the earnings will be. This is what we're projecting. Well, when the company misses that, then the price drops. Well, the problem is the business could still be performing well. They could still be increasing their revenues and their gross profit like Nike is. It's just that they didn't perform the way that other people thought they would. And, it's small, minor margins that they might have missed by. And so it's really not necessarily indicative of the intrinsic value of the company. So one of those things where I try not to read into them too much. I'm going to look at the actual bottom line story like we did today, actually looking at these quantitative factors. So I hope this has proved helpful for you. I hope that you can continue to do your own research, read those quarterly earnings reports, but also keep an eye out for their 10K to be filed with the SEC, hopefully later this month. If you have any questions, comments, concerns, if I got something wrong, drop it in the comments. As always, like and subscribe for more. Helps me, but also keeps you in the loop as I post more of these videos. And as always, dig in, invest well, and I will see you next time.